Welcome to the exciting world of Forex trading, where you have the potential to earn profits by investing in currencies from around the globe. With a daily turnover of over $5 trillion, the Forex market is the largest financial market in the world, offering endless opportunities for investors to make money. Investing in Forex can provide a range of benefits, such as high liquidity, low transaction costs, and the ability to profit in both rising and falling markets. Unlike other types of investments, Forex trading does not require a large initial investment, making it accessible to a wider range of investors. By investing in Forex, you can diversify your portfolio and potentially increase your returns. Forex trading, also known as foreign exchange trading, is the act of buying and selling currencies with the aim of making a profit. Unlike other types of investing, Forex trading involves trading currency pairs rather than individual stocks or commodities. The Forex market operates 24 hours a day, 5 days a week, and is the largest financial market in the world, with daily trading volumes exceeding $5 trillion. This high level of liquidity means that traders can easily buy and sell currencies without having to worry about price fluctuations or transaction costs. Forex trading offers a range of potential benefits that make it an attractive investment option for many individuals. One key advantage is the high liquidity of the market, which means that traders can buy and sell currencies quickly and easily without having to worry about finding a buyer or seller. This also means that transaction costs are typically low, which can help to increase profits over time. Another benefit of Forex trading is the ability to profit in both rising and falling markets. This is because traders can take advantage of fluctuations in currency prices to make money, regardless of whether the market is trending up or down. For example, if a trader believes that the US dollar will weaken against the euro, they can sell dollars and buy euros in order to profit from this movement. In Forex trading, currencies are always traded in pairs. A currency pair consists of two currencies, with the first currency being the base currency and the second currency being the quote currency. For example, in the euro to US dollar currency pair, the euro is the base currency and the US dollar is the quote currency. Currency pairs are quoted using a bid-ask spread, which represents the difference between the highest price that a buyer is willing to pay for the currency, the bid price, and the lowest price that a seller is willing to accept, the ask price. The bid-ask spread can vary depending on market conditions and liquidity. It's important to choose currency pairs that have tight bid-ask spreads to minimize transaction costs and maximize profits. Fundamental analysis is a method of evaluating an asset's intrinsic value by examining its economic and financial factors. In Forex trading, this means analyzing the economic and political events that can impact currency prices. Some key factors that can impact currency prices include interest rates, inflation, political stability, and economic growth. For example, if a country experiences high inflation, its currency may lose value compared to other currencies. Similarly, if a country has a stable political environment and a strong economy, its currency may appreciate in value. Technical analysis is a popular method used by traders to analyze past market data and identify potential trading opportunities. By studying charts and other technical indicators, traders can gain insight into market trends and make informed decisions about when to buy or sell currencies. Common technical indicators used in Forex trading include moving averages, relative strength index, RSI, and Bollinger Bands. Moving averages are used to identify trends, while RSI measures the strength of a currency's price action. Bollinger Bands can help traders identify potential breakouts or reversals in the market. Thanks for watching. Like and subscribe, and we will catch you on the next one.